It was a pretty calm day on Wall Street where we saw the S&P 500 slide just a little bit. It was down 0.32%. The bigger story was really the Russell 2000, where that index finished higher by nearly 2% and did have an impact on its intermediate posture for at least the way that we look at it with the market forecast technical indicator. So we'll take a look at that. We'll then get into our trade application example where I wanted to focus on a stock that was a little bit of a coronavirus theme from last year that's really seen some strong earnings results and has continued its positive momentum here more recently. So I thought we'd take a look at it as a potential bullish bounce opportunity. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's March 30th, 2021. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below to the description area and sign up for our email distribution list. We're also heavy users of Twitter. Feel free to follow me if you're not doing so already. My handle is @BrandonVanZee, and we really appreciate those of you that click like and retweet on these Market Outlook related tweets. And then last but not least, we have a presence over on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into our charts here. And as I mentioned in the intro, you can see the S&P 500 was down slightly today. It was down 0.32%, but that was not enough to change the posture. The S&P 500's posture remains strongly bullish. Remember, for those of you that are premium members of Market Scholars, you have access to all 50 plus of these customized charts, including Chart 4B. And the way that you would read Chart 4B is when you're looking at the background colors, it is telling you what the posture is according to this green intermediate line down below in the market forecast technical indicator. When that green line is either in the upper reversal zone, like it is for the S&P 500 right now, or simply traveling higher between the 50th percentile and the 80th percentile, like it was back here in the first part of March, we would consider that to have a strongly bullish intermediate posture. So despite a couple days of selling here, they weren't too enormous when it comes to the sell-off days. They were just kind of little trickles lower, and so we retain our bullish posture on the S&P 500. Same thing can be said for the Dow Jones Industrial Average. Remember, this has kind of been our leader in recent sessions. We had a great class earlier today in my dividend growth investing class where we talked about the dominance of blue chip companies in this current market environment that is seeking out safer types of investments. So this is kind of the moment where dividend stocks have been shining, and our portfolio is certainly seeing the benefits of that. This particular index here, the Dow Jones, doesn't necessarily have all dividend-paying companies in it, but the vast majority of the Dow Jones 30 are kind of your steady Eddie dividend payers, and so I think they're benefiting from that. Dow Jones did hit an all-time high just yesterday, didn't quite manage it here today. We were down about the same amount we were down with the S&P 500, 0.31 to be exact, and that's still good enough to keep us with that bullish posture. And I would say that the chart on the Dow Jones Industrial Average continues to look stronger than the S&P 500, despite both of them kind of having strongly bullish postures, and that green moving average tells us that price is above a rising moving average. So they share those commonalities there. What makes the Dow Jones chart slightly more impressive is just simply it's had more of an oomph, another adrenaline push to the upside this week with hitting that new all-time high just yesterday, whereas you can see over here on the S&P 500, the all-time high was hit on March 17th, and here earlier this week, it kind of just stalled out there. Now, keep in mind that technology has a much bigger impact on the S&P 500 than it does in the Dow Jones Industrial Average. Remember, there's only 30 stocks in the Dow. Many of them are non-technology types of old-school blue-chip companies. Now, there are still some impressive companies like your Apples and your Microsofts in there as well, so they're not completely devoid of technology, but what you'll find is that technology represents a much bigger portion of the S&P 500. So when you're in a moment of time like we are right now, where technology is struggling compared to a lot of the other sectors, then you'll oftentimes find that the S&P 500 performs a little bit more poorly than the Dow Jones Industrial Average. Down below here on our other two charts, you can see the NASDAQ was down 0.11% today. However, we did finish well off the lows. You can see that we had some long lower shadows here recently, so perhaps some more impressive behavior. As you guys know, as I've been stating for the last few weeks, I've been concerned about the NASDAQ composite, and I still am. However, I will say that this type of behavior is a little bit more promising when we're seeing the index closing well off the lows, and that's what those long lower shadows on those candles are telling us right there. So maybe, just maybe, we're getting some buyers kind of sneaking in on some of those oversold growth and momentum areas. Of course, the big story over the weekend was what was happening with Archegos Capital. For those of you that are premium members, I spent about 20 to 25 minutes in yesterday's Options for Long-Term Investors class explaining how I traded through that whole process. So if you're interested in hearing my story, feel free to check out that recording if you haven't attended that class yet. But it is making impacts on this market right now. Remember that many of those stocks involved are part of the NASDAQ composite. Discovery, Viacom, Baidu over on the Chinese side of the equation, Vips Shops, GSX, Tech EDU, I think is another one that was caught up in it. So there's a handful of stocks that really got punished late last week. Many of them were bouncing back here today as the market started to get a sense that perhaps the forced selling and forced liquidation that was taking place as a result of that family office is likely nearing its end, and it doesn't look at this point like it's going to bleed over and have kind of a domino effect throughout the rest of the market. So we got kind of lucky that that was pretty well contained, at least what we've seen thus far. So it was promising to see stocks like Baidu up so nicely today, and I think that kind of helped the NASDAQ close off of its lows here today. Also, we do have the Russell 2000. As I mentioned in the intro, Russell 2000 was actually today's leader. So while the chart doesn't look as strong over the last 3 months as the Dow Jones, for one day, they did have the sun shining on them. They were up 1.72%. So the small caps had a nice little bounce back. That was a good enough bounce back to actually change the posture. You'll notice over here in the lower right-hand corner where we have the Russell 2000 small cap chart that we've had this breakdown below the moving average. It kind of shares that with the NASDAQ. Now, I still think the NASDAQ looks worse because it spent more time below that moving average. More recently is when we've seen the breakdown of the Russell 2000. That happened about a week and a half ago. And so as you're looking at this chart, the question becomes, what happens when we approach that moving average? I was tweeting with one of you over the weekend about that very thing, as I had mentioned something similar when I was with you guys on Thursday, and the very next day we got that bounce back, and I said, well, the question will be, where do we roll over if we roll over? If we roll over near that falling 30-day moving average, then I'm not all that impressed. If we can get up and through that moving average, then we can start talking about bullishness, and so far it hasn't proven that to me. Again, we've got to take a look at this on a day-by-day basis. This is why we do the videos as often as we do. Today was, you can score one for the bulls. I think there's still some work to do there for the Russell 2000. So I don't think that this new kind of weekly bullish posture is going to do a lot to change my mindset in a big way, but I'm going to stay open-minded toward it. And if we get another couple of big up days, maybe things will change. But until then, I have to make the assumption that this falling moving average that we see right here will likely act as some sort of a resistance here, at least in the near term. Keep in mind that the posture colors, there's 4 different possibilities, so it kind of makes this chart, the Russell 2000, somewhat unique from an educational perspective, because you can see all the colors right next to each other. We had our strongly bullish posture, weekly bearish posture, strongly bearish posture, and now back to weekly bullish. So you can kind of see it cycle through there depending upon where that green line is what is plotting those colors up above. When the green line is in the upper reversal zone like it was back here, of course, you've got your dark green background color telling us we had that strongly bullish posture. When things start slipping enough, when we start changing our minds on that, according to the market forecast technical indicator, and that green line fell out of that upper reversal zone, giving us that what we would perceive to be a weekly bearish posture. That's why that background color is light pink as opposed to dark pink right there. And then as it slipped even further, you can see that green line then crossing below the indicator's 50th percentile. At that point, we then go into the strongly bearish mindset right there. Now, if you can get a little bit of a pop, as we did here today, then that's where you start going into that possibility of weakly bullish. Again, it's not strongly bullish, so there would have to be work to be done in future sessions for us to get back to kind of these stronger green colors like we saw earlier, in recent months. So we've got work to do, I think, is the takeaway there. It's good to see that the small caps didn't just completely roll over here today, and that they had some buying pressure within them. That's a promising sign, but right now you still have to be cautious with that small cap trading below the 30-day moving average there. Let's go ahead and take a look at our 3 green arrows chart now. And this will be chart 4D for those of you following along at home. And as you can see here, we've got kind of a mixed bag depending upon the index that you're looking at here. The S&P 500 actually still has a 3 green arrows signal. That was given yesterday when we had this phantom green arrow on the stochastics here, and we retained it here today, which is why we have that background color on this chart with that greenish color. Over here on the Dow Jones, we actually have a white background color. Reason for that is we haven't had enough momentum in the share price to actually cross us up and back over that 0 line on the MACD histogram. So while we've had, some buying pressure, it hasn't been aggressive buying pressure here for the Dow Jones compared to where it had been previously. So we're kind of in no man's land there according to the 3 green arrow philosophy on Dow Jones. And you can make the same claim down below with the Russell 2000. With today's big move on the Russell 2000 up 1.72%, it was enough to give us a phantom green arrow there on the stochastics. So that was a positive sign there. We'll see if it lasts. Remember, that's the type of thing that could roll over as soon as tomorrow, and you could get a red arrow right back on the stochastic. So you can't really, rest on your laurels, so to speak, when it comes to this sort of thing. And then over here on the left-hand side, again, just to reiterate, it is the NASDAQ that remains the most troubling chart from an index perspective. Notice the background color of the chart is that pink color, telling us that we do have a 3 red arrows signal on this one right now. Price is below the 30-day moving average, which itself is falling. We have the MACD histogram still trading below the 0 line, so despite a few buying days here in the last week or so, we still haven't had enough of an oomph to change the momentum. And then the stochastics is also a red arrow telling us that price is still trading near the lower ends of its ranges. Again, they've impressed me a little bit here in some of these recent sessions, so it is possible that we could get some sort of a phantom green arrow come into play here if we get another one of these, big moves to the upside with a long lower shadow. So be on the lookout for that possibility there with the NASDAQ. Let's go ahead and pop on over here to the internet here briefly and just see what's cooking over there. I always like to get an opportunity to say thank you to those of you that help support this project. Remember that we don't monetize this video. We don't make you watch advertising or anything like that. And so we do it just purely for educational purposes and also to help promote our premium business, which a lot of you are our premium members as well. But hopefully it gets an opportunity to introduce those of you who are not our premium members to our services and get a feel for what the types of things are that David and I teach. So we really appreciate those of you that click like over there on Twitter or whatever your social media venue of choice is. It goes a long way with a small business like ours. Obviously, the word of mouth advertising is kind of our best way to get the word out about ourselves there. So if you appreciate the couple of hours that go into preparing for and then delivering these videos and get the notifications out and all that jazz that we have to take out of our day, we ask one simple thing in return. Just simply click like for us there on Twitter. We really appreciate that. Also, I mentioned earlier today I taught my dividend growth investing class. You're welcome to check out that recording. It is posted to our Trading Rooms calendar if you're a premium member. You also would have access to David's directional option strategies class, although I don't know if he's got his video recorded and posted quite yet, but I'm sure it'll be up there shortly if it's not already. Tomorrow, we've got our factor-based swing trading class where we've had a good string of success here in recent months in that particular class. In fact, last week's class. We put the trade on Wednesday morning. We were out of it by Friday afternoon. Usually we expect to be in trades for about 3 weeks, so we always like it when we get in and out very quickly at profits. So we'll look to continue our success tomorrow morning with that. And then David will be teaching you about options inventory later on in the afternoon there. Also a friendly reminder that we have Good Friday coming up here this week, and of course the stock market is closed on Friday, so we will not have our traditional classes on Friday or over the weekend here at Market Scholars either, as we'll all be enjoying some family time and holiday time there. All right, let's also take a look over here at our sector selector tool. A reminder that we put this together over the weekend. You do have access to a day-by-day version of this if you are a premium member. That would be Chart 1E on our charting program package that we offer you guys. But otherwise, we do get a chance to take a look at it on a week-over-week basis here during this portion of the broadcast as well. And so as of Friday, we still had energy up there at number 1. Now, one thing that I should mention regarding energy is that energy actually had slipped down to number 2 at one point last week, but by the end of the week it got back up to number 1 as almost a fluke. Some of you are aware that as a result of that whole Suez Canal situation, oil prices did firm up a little bit there. So it looked like they were about to roll over, and then they kind of got, you know, an ace up their sleeve to keep their prices maybe a little bit higher than they deserve. So anyway, energy has not necessarily been firing all cylinders here recently. Of course, it's hard to stay as hot as they were earlier in the year. Most of you are aware that energy stocks are some of the strongest on a year-to-date basis at this point, despite the pullback they've had in the last couple of weeks. So right now, we're still kind of in the wait-and-see mode. I don't think I'm ready to stick a fork in it and say it's done. It could be just a situation where energy was overheated to the upside, and it probably didn't deserve those immense gains that it was delivering investors, and now it's kind of given back some of those gains into more of a normalized location. So we'll keep our eye on that story, but just wanted to mention that because I know it's probably been on some of your minds. And then also over here, I wanted to point out that communications suffered a sharp drop here. Now, a friendly reminder that this is on an equal weighted basis here. So some of you might be tracking the sectors from more of a market cap weighted basis. You might have some different analysis on this. But on an equal weighted basis, communications really suffered here week over week. And from my perspective, that's probably because of what happened with Discovery Network and then also Viacom that I mentioned before regarding their role in this whole Archegos Capital liquidation. And a lot of those old line media companies suffered as a result of that. You also had some of the internet companies kind of wrapped up in that. So they kind of had almost like a black swan type of event that really affected the communication sector here in our rankings week over week. And that made room for discretionary, financials, and materials to pop back a little bit higher. We really focused on the steel industry in particular in my top-down trend trading class yesterday. So if you're interested in the steel industry, we reviewed 3 different steel companies from both a technical and a fundamental analysis perspective yesterday in my top-down trend trading class if you want to check out that recording, assuming you are a premium member of Market Scholars. All right, let's go ahead and get back on over here to our charts and take a look at some 12 grid analysis now. And we'll get started with our asset class 12 grid, which will be chart 5A. Now, as this pulls up, a reminder that the background colors of these miniature charts will tell us what the current intermediate posture is according to the market forecast technical indicator. So when the background colors are green, naturally that means bullishness. When the background colors are pink, that means bearishness. Now, there are two different shades of each of those colors. I can't show you an example of the light pink right now, but I can show you an example of the light green, and that is oil down here at the bottom. We do have a light green color there telling us that we do have a bullish posture, but we would consider it weakly bullish, not strongly bullish. Remember, we're using that market forecast technical indicator to help us make that decision. And you'll notice that the green line is at 39.75 and rising. Also, a friendly reminder that if you right-click on those miniature 12-grid charts, you can then go to maximize sell. Once you do that, it'll blow it up into the big screen like this, where you can actually see that green line. When you're on the miniature 12-grid view, you only see the label of what the green line is doing. once you maximize it, then you would be able to see the actual indicator itself. So you can see what has happened here with the green line on oil. We fell out of that upper reversal zone right back here on March 19th. So at that point, we would have gone to a bearish posture. That would have been weakly bearish for a little bit. It would have gone to strongly bearish here about a week or so ago. And then in the last couple of days, we're kind of rounding the corner and heading a little bit higher there on the green line. So with that at 39 and rising, knowing that that is not above 50 yet, we still consider that to be weakly bullish, not strongly bullish. And I think that makes sense in this case. Again, you know, it makes sense to stay hesitant around a chart like this. Yes, we're optimistic that maybe we can find some stability here after a pullback, after a sharp rise that we've had in recent months, but we also have to recognize the reality of the situation, which is oil is currently trading below its moving average. In this case is the 30-day moving average. The moving average itself is still rising, which is why it's colored yellow here. So price is below a rising moving average. So the average of prices continue to go up, even though recent prices have been below that. Generally considered a little bit more bearish there, so you have to be on the lookout for it. But I think the hope is after having this sharp pullback in oil, maybe you're getting a little bit of basing pattern taking place here. I don't know. When it comes to situations like this, where we're below a moving average, I generally want to stay a little bit more cautious around that. You know, there are people that are going to be more aggressive that say, hey, this is your buying opportunity. You can buy this at a cheaper price than you'd have been able to a month ago. And while that is true, you probably also have a greater chance of seeing a failure in that trade. So in this case, I think it's wise to kind of play it day by day. And right now, I think it's slightly more bearish than I would prefer if I were to be trading it with its price below that moving average. All right, looking at some of these other charts here, boy, the dollar has been quite the story, hasn't it? US dollar in the lower left-hand corner. I'm using UUP as our proxy here. So that's the dollar versus a basket of other currencies. And this will give us a general sense as to whether the US dollar is strong or weak. And right now, boy, oh boy, is it strong. It just keeps on chugging higher. And so remember, that can have reverberations across a lot of different asset classes. One thing to be aware of is we are so strong on the US dollar right now, we actually got this little red dot to show up. So let me right click, go to maximize sell here and show you what that means. So you'll notice this red dot shows up down below on the market forecast technical indicator, suggesting that we have what's known as an overbought cluster signal. So we've got the green line, the blue line, and the red line all closing in the upper reversal zone on the same day. So this red dot down below here corresponds with this red dot up here, just so it's a little bit easier for your eye to see what candle it's associated with, which is today's candle. Now, what's interesting about this is that the dollar was so far out of favor about 3 months ago. Notice back here on January 6th, the dollar was in such a sell-off mode at that point, it produced an oversold cluster signal. So those of you that would have been brave enough to buy that oversold cluster signal back here, you've had one heck of a run from oversold cluster signal to where we're at right now at overbought cluster signal. As mentioned before, that does have the tendency to have reverberations across other asset classes, including commodities. You'll notice the chart directly to the right of the US dollar, which does not look appealing at all, and that is gold. Let me right click on that and show you what this looks like, kind of blown up here. And you can see that this is actually like a pretty good bearish trade setup here. You know, I kind of am regretful that I didn't do the market outlook video yesterday, because this would have been the day that would have really caught my eye. Here I would have felt like, yes, my assumption is that it is going to fail, and I think I even mentioned that last week when I did the video on either Thursday or Tuesday, but I probably wouldn't have been bold enough to take a trade yet, just setting my assumptions and then looking for my levels. On this day here, this was a significant day to me, and this was yesterday, where we broke down below some of this significant support level where we've been trading on gold for really the last 2 weeks, and we had a continuation of that move here today. Gold got hammered today. It was down 1.7%. In fact, this is basically the lowest close on gold, if I'm not mistaken, for the last 3 months. So let's just check this candle right here. I'm going to look at this C colon up above. That tells us what the closing price is on the candle that I'm pointing at. And in that case, the closing price was 157.49. So not quite, nearly a 3-month closing low here, within basically just a couple of dimes there. So in other words, maybe, just maybe, you're going to have some buyers show up. I don't think they'll be too aggressive, but they might say, hey, it's worth a flyer since I'd have such a tight stop loss here. Maybe get involved and see if they can push that up a little bit tomorrow. But right now, I'd say the odds are highly against them. This is a significant downtrend that gold remains in right here. Let's go ahead and do some sector analysis now. Coming on over here to chart 5C. And as you can see here, we do have two pink charts on the board. We've got communications and we've got technology. Now remember, those are some very important areas of the market, particularly technology. Technology contains Microsoft and Apple, two of the largest publicly traded companies on the planet. And then in the communications world, you're going to have stocks like Netflix and Disney, Alphabet, Facebook, also very important companies in the world's eyes. So I don't necessarily like seeing these particular charts in red. It gives me the sense that this is more of a risk-off era that we're in. And again, like I mentioned earlier in this presentation, we already know that, right? We've already recognized that dividend stocks have really come to life here recently. This is their moment to shine. And so this is not necessarily an area, when you think about dividends, you don't think about technology and communication stocks traditionally. So this is an era where we're in right now that's kind of existed here for multiple weeks. Part of it is the Cathie Wood story that I shared with you before, and some of the negative domino effect that happens from some of those sells that take place. But I think a lot of it is also just risk appetite in general doesn't know where to take this market right now because we've had such an extraordinary run over the last year. And so this is not a great sign for the market when you see a couple of the most important areas like technology and communications kind of sitting things out right here. However, depending upon where you're at in the market, there are some decent looking charts out there if you're kind of careful about picking your spots. I would say that industrials looks rather impressive here. Notice that industrials on an intraday and a closing basis hit a new 3-month high at least. It might even be more than that, but at the 3 months I see on this chart, the industrials are basically at highs right here. So that chart looks rather impressive. Staples was really making a move, and some of you have recognized that. I got an email from one of you about the Kellogg's sold put trade. Remember, I did that Leaps sold put in this Market Outlook presentation a few weeks ago on Kellogg's when it was really out of favor. And boy, that particular trade has already captured more than 50% of its profits. And remember, we were planning on being in it for years. And so that just goes to show you how quickly these very sleepy consumer staples companies have come to life. You can see what XLP looks like, where we were just hitting multi-month lows on March 4th, and we've just ripped to multi-month highs nearly every day along the way. Today was a give back day on the staples. We were down over 1% there, but that has been a tremendous move off of the lows for the staples there. We've also seen a really nice move out of the real estate space. That was the area I focused on, by the way, today in my dividend growth investing class. A reminder that you should evaluate real estate investment trust differently from a fundamental basis than you would evaluate the 10 other sectors that are out there. Real estate companies are traditionally valued on more of a cash flow basis, particularly funds from operations per share. So if you're interested in that conversation, I would highly encourage you to watch my recording from our dividend growth investing class earlier today if you're a premium member. But that particular chart is looking rather impressive here from a price strength perspective off of some of those lows about 3 months ago there as well. I'll also point out quickly that discretionary, while the chart does not look all that great, I will point out that at least discretionary does have a strongly bullish posture right now. And the reason I'm pointing that out is because this will now transition into our trade application example, which does come from the consumer discretionary area. Now, a reminder that all of you that are our premium members of Market Scholars would have already learned about this trade through the Telegram app. And so let me go ahead and pull up chart 3A here. I usually do these trades in the final half hour of trading and then send out the alerts to you guys so that way you can consider trading them for yourself if you so desire. Of course, that's not a suggestion, but at least gives you the information for you to make your own decision there, whereas everybody who's watching the free video at night wouldn't get to place their trades until the following morning. So the stock in question is WGO. This is Winnebago Industries. Probably not the most exciting stock that you'll ever hear about, but as I mentioned in the intro, this kind of had some appeal during the coronavirus era. A lot of people took towards the outdoors once again, since we couldn't be all jam-packed in sports stadiums and malls and concerts and different things like that with the whole global health pandemic. So a lot of people took towards the outdoors and rediscovered nature, as it were. And so RV sales were just through the roof. And Winnebago is going to be one of the key companies that takes advantage of that. You'll notice that they just put in their earnings here on the 24th of March, and they put in at $2.12 earnings. The analyst expectations were only $1.39. So they just blew the number out of the water, and you can see that that was able to basically stop the bleeding of that stock chart. Now, this is a pretty impressive 3-month chart here for this particular company. It was really only the last 3 weeks or so where this thing started to look a little bit like the wheels were coming off of this particular RV. And then that earnings announcement there kind of saved them and kind of put them back on the right track, put them back on the road, so to speak, between the lines. And so now all of a sudden you can see with today's pop, we're back up above a rising moving average. Notice that the moving average color was yellow just yesterday. With today's big move, and we're up about 5% here today, we're back above that rising moving average. So hopefully this was a bounce opportunity right here. So this is going to be a bullish swing trade where we're buying the shares and we're going to target this area up here, which doesn't require us to break through the old highs, but kind of forces us to kind of get back into the top halves of a lot of these candles right here. So really it looks like as long as it's in the top half of that candle, we're good, or even in the bottom half of those other 4 candles. So in other words, we're going to put our stop loss a little bit below the low of this candle where it bounced the other day, and we're going to shoot for this price target up here just a little bit below those prior highs. So in other words, if this stock does continue to bounce higher as it has so many times in the last 3 months, and if this thing is destined to hit yet another high, and hopefully it does that before going lower first, then we would be able to extract our profits from that situation there, okay? And you can see that we do have a bullish near-term posture here with this blue line going higher. So that's what we would use for a swing trading purpose as opposed to the green line, which you tend to use as a trend trading purpose. So that's what I had for you here tonight. Again, if you got value out of the presentation tonight, whether it was this trade application idea or just an idea of understanding where things stand in terms of the general market conditions, the strength of the dollar as an example, or where things are falling with energy stocks, or why communication stocks fell off of the map last week. If you learned something in this presentation, one simple request out of you, just simply click like for me there on Twitter. I'll have it pinned to the top of my timeline. You can also access Twitter directly below the video on our website if you're watching it there, or for those of you that are watching it directly on your YouTube apps, we do have the Twitter link in the description area on YouTube as well. So lots of different ways for you to accomplish that. We really appreciate you spreading the word about Market Scholars. So with that, I want to wish you all the best of success with your trades and your investments. Goodbye for now.